bid to prevent another crisis in Nigeria's banking sector, the Apex Bank plans to place restrictions on lending relationships between banks who have now adopted the holding company structure and their subsidiaries. CNBC Africa's Umu Ibrahim talked to the central bank governor, Sanusi, on reasons behind this move. Let's take a look.
This circular was for us our own electrified ring fence. If you think of a holdco that owns a bank and say an asset management company or stockbroking firm, you can think of a triangle. Money can move from the bank to the holdco. It can move from the bank to the subsidiary. It can also move from the subsidiary or the holdco to the bank. Now we have no problems with the holdco and the subsidiary giving money to the bank. That's a loan. What we have a problem with is depositors' funds being transferred to, say, a subsidiary that is doing non-banking business and taking non-banking risks, and then being used to take those risks. This is what brought down Oceanic, this is what brought down Intercontinental, and it doesn't matter whether it's under one roof or under two roofs, it's the same process. Deposits are not supposed to be used for taking non-banking risks. So what we've done is to say a bank can obviously lend to the subsidiary on an arm's length basis, fully secured, so that we know that the money is not being used for those risks. If it lends to the subsidiary unsecured, we will assume that these are depositors' funds that are being used for non-banking risks, and therefore we take it out of the bank's capital, not deposits. In the case of the holdco, it's a slightly different situation. It's a situation in which a holdco can, in theory, put in capital in a bank and then turn around and borrow that capital, and therefore take it out. So if a bank lends to the holdco, we take it as a return of capital and take it of its capital. So this is basically, these are basically prudential guidelines that are aimed at ring fencing deposits and making sure that they do not get into non-banking business.
Banks cannot lend more than 20% of their total loans to a particular sector, for example, the agriculture and gas sector. But some say the energy and gas sector need a lot of funds these days, and the banks are unlikely to change their stance towards the SMEs in the short term. Isn't this policy counterproductive, since it is unlikely to lead to the diversification that the central bank wants to achieve?
When we deal with credit portfolios, we're not dealing with economic sectors. We're dealing with what are called standard industrial sectors. So, for example, in the credit portfolio, there's nothing like manufacturing. So manufacturing, okay, actually is made up of so many industries. Each of those industries can have more than 20%. Oil and gas exploration and production is one industry. Oil and gas services is one industry. Oil and gas marketing downstream is another industry. And therefore, when people say, oh, oil and gas 20%, they should think of, does it really make sense for a bank, for example, to have more than 20% of its portfolio to petroleum marketers? There's a misunderstanding on the definition of industries, and I think we will have to issue some clarification for that, because even some of the banks have, and we did issue these standard industrial classifications in 2009. So we need to remind the banks that this is what this classification is.